Hello guys, welcome back to another video. And as you all can see, we are on a trade on V50 index. We're on a buy trade. And what's our approach in this market? What gave us the buy bias in this market? How did we get into this trade, and why did we get into this trade? And that's what we'll explain in this video, so stay true to the end of the video. And we'll explain the strategy we use in getting into this trade, the highs and lows of the market. That's what we use in getting into the trade. So how do we identify the highs and lows in the market? So as you can see at this level, we got a level at this point, we got all the level at this point. And when identify these highs and lows in the market, you use the daily time frame basically. So you can see the highest point at which the market went to on the daily time frame, or the lowest point at which the market got to on the daily time frame. So as you can see at this point, we got a low at this point, but the market failed to buy off from this zone. And in this strategy, we buy at the lows of the market and sell at the highs of the market. No one would want to buy a goods or a product when the cost is high. Everyone wants to buy a product when the cost is low. As you can see, the market is actually at a low, but at this point, the market failed to do what? We got less buyers in the market that failed to request for these products, or that failed to purchase this product. So as we got to this point, the market failed to give us what? A nice buy at this level. Instead, the buyers failed to still buy. Basically, why did they fail to buy? Because they are looking at for a particular level at which they think the market is favorable for them, or a price at which they think the cost of the goods is favorable to them. Because at this point, basically, these numbers at this area are prices of the market. So let's assume that this V50 index is a commodity, and everyone wants to come buy and sell. Like, people want to buy and resell when the price is higher, so, and these numbers at this area is actually the price of the market. So the lowest point at which the market got to before we had the buyers coming to the market to come buy the product was at this level. So when these goods got to this zone, like this lowest low at this point, we can see that there are no buyers interested in buying these products. So the market still had a low. Like, for example, the market was this particular index was sold at 197 naira. Like, that was the lowest level at which the market was bought. Like, people, like all these retail traders, that was the lowest level at which the market was bought. So the market got to this level. Initially, before buying at this level, they had the level at which the market was bought lower at the 174 level, 175 level. They were actually expecting the market to give us a decline in price for them to get into the market, or for them to buy the products so they can sell it when the market gets higher. So that's actually the strategy we're using approaching this market. So you can see the market heading to this level. You can see the market headed to this point. That's the level at which the market is trading at now. So that's the lowest low, like the lowest low of the market, because we actually had this low, this previous low, which is not lower than this low. So people were not interested in buying these goods at this point. So they are waiting for the market to decline more to this zone, to this price, so they can buy and resell, so they can make good profits. So that's why we got into this trade at this point. And we had a high at this point, basically. So you can see the market is giving us this high at this zone. You can see the market is giving us this high. That's the level, that's the highest price at which the market was sold out. Like, people who bought at this price level sold at this highest price level, which is at the 231 level in the market. So as they bought at this level, they bought at 176 level. So they would want to resell the goods when the cost of the goods is higher, so they can make good profit. So on how we sold the goods when the goods is higher, you can see the price of the goods started doing what's declining. Like, you are less quest in the market, like less people who are interested in buying the goods. So you can see the price doing what? Declining, so it can attract more buyers. Like, because when there's a decline in price, the goods actually attract more buyers, and people who are interested in the goods would want to invest their money into it, so they can make good profit or good returns when the price of the goods rises or increases. So you can see the market gave us a sell-off at this point, then coming back to this level to give us what? A buy from this level. Like, people who sold at this level came back to buy at this point again, because they felt is a level at which they can buy and make good profit. So as they bought from this level, the market rose back to this high again. Like, people wouldn't want to hold their price, their goods, to a level at which nobody will be interested in buying it from them again, because people who bought from this level will want to resell at this level. So they would want to resell at a favorable level, so they can be in profit, so they wouldn't make any loss in the market. So that's why they sold at this level. So on how they sold at this level, the market did what? Declined. They sold at this level. They sold all their goods at this level. they sold all their goods at this level. Then the market did what? Declined lower. But on how the market declined lower, people were less interested in purchasing these goods. So the market, the price of the goods kept doing what? Decline, and it declined lower to this particular low. So our prediction is we're expecting the market, on how the market got to this low, this 174 low, expecting the market to give us what? A buy, a rise in price. Like, we're expecting the buyers to come into this market at this point to give us, like, to show interest in the goods again, so they can be able to buy up the goods and resell higher. So that's basically the logic between buying the lows and selling the highs in the market. So, and we got a high at this point as well. We got a high at this point on the day time frame as well. So you can see there was a rise in price at this level. Like, this is the highest level at which the price of the goods was at. And whenever the goods gets to this price, for example, we want to purchase maybe a shirt, a pair of shirts, or a, okay, let's say a shirt, want to purchase a shirt, and the cost of the shirt was at 100, and like, you purchase the shirts at, let me say, at the level of $214 per pair of shirts. Then would want to resell the shirts when the shirts add value. As the price increases, the value of the shirt does what? Increases. So on how the price increased at this point, we got more buyers in the market who bought the shirt. They're adding value to the shirt, because whenever product is costly or expensive, it actually shows that the product has value. So on how they bought the product at this point, you can see there was increase in value, there was increase in price in the product, and there was a level at which the product couldn't exceed. Like, there wouldn't be people they can sell the product to. So that's why they all sold their products at this level, at this highest high at which the market went to. So that's basically the logic behind buying the highs and selling the lows in the market. So you can still check more levels. So you can see at this level we got the low at this point. People are buying at this level. On how they are buying at this level, the value of the product increased, like the price increased, and they sold at this point and they made good profit. Like, they bought at a lower cost and selling at a higher cost. The same thing applies at this level. So everyone who bought this lower cost will want to sell back at the highest high of the market. So that's why they sold all their product. No one was interested in buying, in holding the product again. So they have exhausted all their sales, and the market did what? Declined in price, and the market fell from this point. So you can still move to see more price levels. We got the buy level at this point, and we're actually moving in profit. So we are buying this, we bought this low basically because that's the lowest low of the market, and we expect we expect buyers to have interest in these goods. That, like, we expect the buyers to be interested in buying this product again, because it has gone to a lower fee, a lower cost. No one wants to buy an expensive good. So we bought this level so we can sell at a higher level and make good profits. So that's basically the logic behind buying the lows and selling the highs in the market. Next time frame used in analyzing this chart, or applying this logic in the market, is the daily time frame, because you can see the daily highs and the daily lows. Basically, the higher time frame is the best time frame used in spotting the highs and lows of the market. So your comment on this video, like and subscribe if you're a new viewer. To my returning viewer, shout out to you guys. You guys are the OGs. Let's keep doing what we do, guys, and do have a wonderful day. Peace out.